Today we're looking at three S&P 500 charts. Let's start with the question. If I were to tell you that the S&P 500 closed above its intraday midpoint over 80% of the time over any given period, would you say that the market was up or down over that time? Of course, the answer is up. And the same goes for the reverse, where it only closed below the intraday midpoint 20% of the time. And so both of those have occurred since the October low here. And now in the preceding period, just up that point, of course, the opposite was true, where we saw 9 closes below the midpoint in 12 trading sessions. And not surprisingly, the market was down, of course, this being the last leg of a 3-month decline. And so from a slightly different perspective, it took 46 trading days right here to get 9 closes below the midpoint. So it just gives you a sense of why it's so important to focus on the short term. So any given day, we can't really get too much guidance, but you put this all together and it tells you that patience is key. And looking at the short term market action for some clues can tell you, or at least give us an indication when the trend is changing, or at least the character of the market is different. And so as of right now, things have slowed down up here, of course, but we still haven't seen this type of action occur yet as well. And so in terms of divergences, looking at new highs, we know the last time we had a spike was in the middle of December, where we had 107 new highs, and it hasn't really been close to that since. And that's a concern given the fact that the S&P has been testing its own 52-week high here, not quite above it just yet, but clearly hasn't had many components underneath the surface do the same. And so that is a divergence that we have to be concerned about, considering that, we've come so far so fast in such a short period of time. But we can't look at this just in the vacuum, right? And we look back to what happened in 2020 and 2021, where we had the first spike above 100 right after, coming back from those 2 different corrective periods in September and October. And then didn't get back above that level until springtime back in 2021. So all along the way, of course, there were naysayers, didn't believe this can continue. One reason being that we hadn't had the support of new highs along the way. And that even occurred after this, right? But if you really look at this, it's really about the relative peaks right here, because it was much different right on the way up. Of course, everything coming back from the COVID lows, but eventually you got up to 80s, 90s, again, even afterward, right? Still didn't get close to getting back to 200. And that was always in the back of people's minds, but we didn't really fall off a cliff until things started to roll over again in 2022. And so really the same type of notion should be in our minds now, where we have 100 here, not close to it again, but as we keep going, and if the market continues higher, you want to see this, the average at least, get higher, right? And that will mean that there's rotation going on underneath the surface and so forth and so on. Now, the other part of it is that we haven't gotten above 40 in a while either, but right underneath the surface, there are, as of right now, 100 S&P 500 names within 3% of their own 52-week high. So we can see how this could play out, where if we do get a marginal break and eventually get back again above new all-time highs, which isn't that far away, is going to pull more components with it, and we can eventually see this spike relatively quickly, right? If that happens soon. But if not, again, we want to see the peaks just continue on average to get better. And that's what we'll be looking for over the next few weeks. Don't forget to check out these 2 videos here and subscribe, and talk to you next time. Thank you.